In late 2025 and early 2026, one of the most powerful financial institutions in the world quietly became the largest private holder of physical silver on the planet. The institution was JPMorgan Chase, a bank that years earlier had paid nearly $1 billion in fines to settle charges related to manipulative trading practices known as spoofing in precious metal markets. The scale of this accumulation is remarkable. Based on available vault movement reports and market analysis, JPMorgan's accumulated physical silver holdings are estimated to exceed 750 million ounces, placing the bank well above any other private entity in terms of tangible metal control. This development, which unfolded amid a period of a heightened commodity, volatility, and supply constraints, has profound implications for how silver is priced and traded in 2026. To understand why this matters, it is necessary to unpack both the history of the bank's involvement in the silver market and the mechanics of physical supply compared to financial speculation. Silver markets have a long and complex history, woven through both industrial usage and financial speculation. Unlike gold, the majority of silver is consumed as an industrial input. It is embedded in solar panels, electronics, medical equipment, and industrial machinery, and much of this material is not economically recoverable once it is used. This means that, over time, above-ground silver inventories shrink because industrial demand permanently absorbs large volumes of metal. For years, JPMorgan was widely viewed as a dominant force on the paper side of the silver market rather than the physical side. In 2020, the bank agreed to pay a substantial penalty, in excess of $900 million, to settle allegations that certain traders employed spoofing techniques, placing orders they intended to cancel in order to influence prices of precious metal futures. That episode exposed the bank's deep engagement with futures contracts and its capability to influence market behavior through trading activity. Yet the bank's relationship with silver did not end with that settlement. Over the course of 2025, JPMorgan made a dramatic shift from a net short position in silver futures, financial contracts that represent future delivery, to a net long position in physical metal. Between mid-year and late 2025, the bank reportedly disposed of its remaining 200 million ounce net short position and redirected capital into acquiring real silver, transforming its role from a persistent source of downward pressure in futures markets into a major holder of physical supply. This shift is significant because the mechanics of physical silver differ fundamentally from those of paper markets. Futures contracts allow traders to gain exposure to price movements without taking delivery of metal. They represent promises or claims, not tangible assets. Physical silver, by contrast, must be sourced from mining output, recycled material, or existing stockpiles, and is limited by real-world logistics and production constraints. In 2025, demand for silver surged. Silver prices reached multi-decade highs as investors and industrial buyers responded to expectations of easing monetary policy, supply disruptions, and strategic purchases. At one point, prices exceeded $60 per ounce for the first time in history before retreating from peak levels later in the year. This backdrop of tightening supply and rising demand made large, available inventories increasingly valuable. When an entity with the scale of JPMorgan begins to accumulate physical metal, it removes that metal from circulation. Unlike an ETF or paper position, which can scale exposure without necessarily changing underlying inventories, physical accumulation has a direct and mechanical effect on the available stock of tradable metal. The size of JPMorgan's accumulation is noteworthy not only for its scale, but for its structure. Holding over 750 million ounces places the bank in a unique position relative to the rest of the market. Much of this holding appears to be outside the traditional dynamics of exchange inventories that traders use for immediate delivery. Instead, the metal is reportedly housed in private vaults under the bank's control. There are two key consequences of this situation. The first is that physical supply in accessible markets may be far tighter than headline supply figures suggest. Publicly available COMEX inventories, the quantities of metal held in exchange-authorized warehouses, can mask the fact that large blocks of metal are privately owned and not available for delivery. This reduces the effective float available for settlement and trading. When inventories are low relative to demand, even modest increases in physical buying can exert outsized pressure on price. The second consequence relates to market expectations and arbitrage behavior. When a major financial institution with a long history in commodity markets shifts its stance from short to long in physical metal, Other market participants take notice. This change can influence hedging strategies, trading flows, and the terms at which dealers are willing to lend or lease metal. It can also affect how exchange inventories are factored into pricing models. At the same time, industrial demand for silver remains robust. Solar panel producers, electronics manufacturers, and other industrial users continue to consume significant quantities of metal. This demand is largely inelastic in the short term, meaning that buyers cannot easily defer or substitute away from silver without incurring operational costs or performance drawbacks. The intersection of high industrial demand, constrained mining output, and concentrated private holdings creates a market environment in which price discovery becomes sensitive to physical tightness. Even if futures markets continue to trade actively, the linkage between spot prices and actual availability can weaken. This divergence can lead to premiums in physical markets or unexpected volatility when delivery obligations come due. It is important to emphasize that JPMorgan's accumulation of physical silver does not, in itself, guarantee any specific price outcome. Markets do not move solely in response to one factor. However, the presence of a private actor with such a large physical position changes the structural dynamics of the silver market in 2026 compared to previous years. In a market where accessible inventories have been drawn down and global demand remains strong, the existence of a private stockpile of this magnitude introduces a new variable. Participants in both physical and futures markets must reckon with the fact that a significant portion of available metal is held outside traditional exchange systems. This shift is not purely academic. During periods of stress or rapid repricing, it could influence how markets adjust to changes in supply and demand. If industrial buyers are forced to compete with large holders for delivery, that competition could accelerate price moves. Conversely, the bank's decisions regarding leasing, lending, or selling metal could provide intermittent supply relief or deepen tightness. Ultimately, the story of JPMorgan's Silver Vault in 2026 is not a conspiracy, nor is it a simplistic tale of manipulation. It is a structural narrative about how large institutions can change the mechanics of commodity markets by reallocating capital into physical assets at scale. Understanding this shift is essential for anyone trying to make sense of silver's price behavior in the current economic environment.